Hi guys, welcome back to another video. As you know, nowadays macroeconomics have changed a lot and market has been very red recently. So with this video, I would like to share with you a golden rule that is always successful in investment, and that is compounding investing. If you enjoy my content, it will be greatly appreciated that you subscribe, like, so that more people would be aware of my videos and the concepts that I explain in my videos. So, compounding interest in the long run has always been the golden knowledge for investing. It helps to remind investors about learning to be patient in order to be successful in the stock market. In this kind of market, it is definitely a reminder that it is always important to be focused and to look at the fundamentals of the company. With all the share prices being so cheaper and cheaper, some of the values are at a very good price to buy. So looking back at the prime example of Warren Buffett, not a lot of people mention about how consistent he has been investing in some companies and holding them for the long run. With the growth and patience, his assets started compounding from 376 million to 58.5 billion in 32 years. Even though at this time of his age, his assets or net worth looks a lot, but if you look at the chart, his net asset compounded really occurred at a very later stage. So this actually shows or justifies the concept of compounding investing throughout his life. So what can we actually learn from this? There are a few lessons that we can learn from it. Firstly, be a consistent investor. Stock market is very unpredictable. You do not have to aim to buy at the lowest point or as it's going up, but rather buying along the way down or when the market is favorable. Buying times like this would tend to give a higher return than usual. Secondly, investing for the long term. Companies with long-term growth should be good and ignore on the short-term gains or downturns, because fundamentals will always win in the long run. Thirdly, analyze on your company that you are interested in or investing in, and stop predicting on external factors that you can't control, such as the global economics and interest rate. Essential companies like Coca-Cola will always be the favorites for many people regardless of the world economy, and people would still like to drink or eat foods that people like. Lastly, only invest in things that you understand. Time and time again, Warren Buffett mentions about how he do not invest in things he do not understand, such as the prime example of cryptocurrency. Similarly for us, we should also read up and only invest in things that we can relate, especially in the industry that we are working in, so that sometimes when the share price drops and we know we are confident fundamentally about the companies, we do not panic and sell it at the very low price. So let's take a look at the clip from Warren Buffett on someone asking about investing in times of uncertainty.
In view of the Iraq war, consumer debt that's increasing, declining job growth, declining pay in the jobs that are growing, prospects of increased interest rates, he has this view that the next 5 to 10 years are going to be very difficult. What would your view be about the investment future for the next 5 to 10 years in view of all these negative factors going on?
That's too soft for me. I think Warren should take that.
Well, I would say that at any given point in history, including when stocks were their cheapest, you could find an equally impressive number of negative factors. I mean, you could have sat down in 1974 when stocks were screaming bargains, and you could have written down all kinds of things that would have caused you to say, you know, the future is just going to be terrible. And similarly, at the top, you know, or any time you can write down a large list of things that would be quite on the bullish side. We really don't pay any attention to that sort of thing. I mean, we have, you might say that our underlying premise and I think it's a pretty sound underlying premise, is that this country will do very well. And in particular, it will do well for business. Business has done very well. The Dow went from 66 to 10,000 plus in the 100 years of the 20th century, and we had 2 world wars and nuclear bombs and flu epidemics, and you name it, Cold War. There are always problems in the future. There are always opportunities in the future, and in this country, the opportunities have won out over the problems over time, and I think they will continue to do so absent weapons of mass destruction, which is another question, and business won't make much difference if anything really drastic happens along that line. So I can't remember any discussions Charlie and I have had ever going back to 1959 that where we would have come to the conclusion at the end of them that we would have passed on a great business opportunity, a business to buy, because of external conditions, nor did we ever buy anything that we thought was mediocre simply because we thought that the world was going to be wonderful. It won't be the American economy, in my view, that does in investors over a 5 or 10 or 20-year period. It will be the investors themselves. If you look at the record of the 20th century, you'd say, how can anybody have missed, in owning equities during that time? And yet, we had all kinds of people wiped out, in the 29-32 period. We had all kinds of things that were bad. But if you would just own stocks right straight through, didn't leverage them, you'd have gotten a perfectly decent return. So we're unaffected, in essence, by the variables you mentioned. Just show us a good business tomorrow and we'll jump at the hook. Charlie?
So currently, there are a lot of similar events that has happened back then when you compare to the Warren Buffett video, such as the Ukraine war, the shrinking or downfall of China's economy, US interest rates, and global inflation. Many items are out of our control, and staying on course to invest is always the right thing in the long run. Looking at the recent CPI data, markets went very red as the inflation for September of 2022 came in slightly lower, but not as low as the market or analysts expected. Moreover, food still has been increasing with a month-over-month increase of 0.8%. If you analyze it, it will be an increase of 9.6%. Another parameter that has a very high weightage on the US CPI data is the shelter, which contributes 32.47% of the overall CPI and came in at 0.8% month over month as well. So as the Fed increases the interest rate, people overseas are not able to afford houses because higher interest rate means that people tend to be able to borrow less to buy houses, and this forces people to actually rent instead. However, since CPI data is always a lagging indicator, new articles are actually mentioning about cooling housing markets with rents dropping. So it will be interesting to actually see how the future CPI data will look like. For now, markets are pricing in that the Fed would guarantee to increase by basis point of 0.75%. Of course, all these factors are hard to control, therefore we just have to be patient and continue investing our money to keep inside the market for the long run. Of course, with many uncertainty in the environment and the interest rate continuing to increase, REITs definitely have some risk as well. Therefore, it's always important to do research and calculation to make sure that the REITs that you are buying and you are comfortable if it drops in value. In my opinion, with the market's rate, it provides us with more opportunities to have a higher return in the market in the long run. With the drop in the REITs and the stock prices, they will give a more attractive view and thus giving the power of compounding to be even stronger. So let me show you how the different yields or percentage can really make a lot of difference in the long run. So there was actually a concept that I would like to test on compounding interest with different REITs. Some dividends are being given in semi-annual, while some dividends are given in quarterly. So with that curiosity, I've come up with a chart to compare on the results that will be able to be given. So let us look at person A and person B. So for person A, the dividends are assumed to be in quarterly, while person B, the dividends are assumed to be in semi. So if we look at the principal amount and the yearly dividend yield, we fix it as the same amount of 100,000 and with a dividend of 5%. So from there, if we look at both graph or both columns, for quarterly dividend of from year 1 up to year 21, you will achieve a value of $283,911, whereas for semi-dividend would achieve $282,099 in year 21. So the difference by year 21 would be $1,811. It does not really look much difference, but a few different values would actually make a very big difference to the amount that you receive. So if you look at the table, although currently at 5%, it doesn't look like the difference will be a lot. But honestly, if you invest in REITs and invest in good REITs in the long run, 5% is a very easy hit. If we change the value to 7%, the big difference would definitely be impacted. As you can see, the difference between person A and person B has increased to $5,302. So let's say throughout your years, you have been doing very well and saving a lot, and you wanted, or you have a lot of spare cash that you have invested in growth, and you have quite a bit amount to invest in REITs as well, or dividend stocks. So if every year you're able to input 10,000, as you can see from the difference, person A and B difference would actually become even bigger at $8,667. But honestly, if you are feeling that this does not really make much of a difference, having REITs of either semi or quarterly is good enough as well. So let's look at another case study which truly shows the power of compounding interest. If you can see with this new person of person C with the same principal amount and the yearly dividend of 5%, you can see that if he started 11 years later, it can only compound from year 1 to year 10. If you compare between the year 10 of person C and the year 21 of person A, you can see that there's a huge gap of $119,549, and that's only at the yearly dividend yield of 5%. If the interest or the yield of your investment is even higher, it is even more bigger in difference. So with this table, what does they actually tell us is that always invest early and be consistent with the investment. If you are confident with the investment, even though the stock prices drop, it's better that you can hold it and or even buy it at a cheaper price at a higher yield that you can compound into the future. So in conclusion, I hope this video actually emphasizes on the power of compounding interest. By investing always for the long term, it will always give good returns, and in my opinion would have lesser risk as compared to constantly buying and selling based on macroeconomics. So with this video, I hope that you have some good takeaways, and please like, subscribe and comment on anything that you would like me to talk about next. You can also access my Excel sheet from the previous video that I've talked about and on macroeconomics on different REITs industries that I would feel that they will be more resilient to recessions. Thank you. To the next video.